As you well know, we can't keep track of all the schedules. We've got a whole team that does that. Hanishawa has just sent me the schedule for the morning. Really quickly on the afternoon in the pomp and circumstance at the Capitol. 12 noon, the House managers will attend the Senate chamber and read out the articles of impeachment in full. At 2 p.m., Chief Justice Roberts will arrive. He will meet with Senator Grassley and be sworn in, and then the Chief Justice will swear in the senators as well. And this sentence is remarkable, Francine. Under the Senate impeachment rules, the President of the United States is summoned and given a time to respond. I'm uncertain what that will mean later this afternoon. Right now in the investment world, Stephen Stanley with us with Amherst Pierpont, and we are thrilled to bring you David Pearl. To say he is co-chief investment officer at Epoch Investments barely describes his commitment to securities analysis and value and even growthiness investment. How are you holding up? Let's just go to a general statement. Bull market, and then boom, the first 2 weeks of this year.
Yeah, it's actually been pretty good, but what I would characterize is last year was driven by good earnings growth and a lot of multiple expansion. Really, earnings were good, high single digits, which is pretty good for the long-term history of the market, but you don't get double-digit returns without valuation going up. And that's the real question going forward. How much more valuation can you put on this market?
What is the history that you see, David Pearl, of the multiple expansion sustaining or giving itself up suddenly? What's the history of that?
Well, it's a tie to the economic growth. So as long as growth is good, you get speculation. And we've seen for the last few years that speculative growth stocks, in particular stocks with no earnings, have outperformed the market. This will reverse itself when we go into some sort of a slowdown. In Q4 of 18, when the market perceived the risk of recession, the market was down a lot, and those speculative stocks were down twice as much. So it's a quality year if you want to hold on to your money, own companies that earn real money, that can grow at least kind of mid-single digits or higher, about the average or a little higher than the market, and you're looking at a high single-digit return this year. The average of the stock market is 8 to 9%. I would take that in a minute, and if you get dividends of 3 or 4%, you're halfway there. So that's the strategy for this year. Do not hope for valuation. I could give you an example of Apple, which everyone loves right now. We had owned Apple for over 10 years, and for over 10 years, Apple was at a discount to the market. Everyone thought the next iPhone would be a bust. Last year, Apple was up 80%. It's all valuation because their earnings were down. Their revenues were down and earnings were down, stock up 80%. So suddenly Apple is a growth stock even though the numbers don't bear it out. That's what we're worried about.
Let's bring in Francine in London. Francine?
Yeah, David, I was just going to ask you about margins. What do you do with margins this year? Is this the metric that people will focus a lot more on when it comes to earnings?
Yeah, we do think so, because if you can control costs and increase margins, that's within your power. You can't always really control demand for your product. So companies that can do this are going to win. When we're talking about financials this year, that has been a big part of the story for companies like Bank of America, or we'll see for Morgan Stanley, that margins are going up. And it may be more of a return of capital story than a growth story, but that's okay. If you can return capital, pay a dividend, you can get a double-digit return, even if you're not, a hot growth area. So there are going to be a lot of areas in the market where companies control costs, increase profits, and outperform.
What's in a bubble right now?
Some of the growthy tech stocks are, interestingly, some of the bigger ones are not as bad as you would think. Google and Facebook are actually not that expensive. Microsoft has finally gotten to a point where it's priced probably correctly, but it's a great company, and the earnings are going to be very good. It's more the smaller names like Netflix. Obviously, everyone talks about Tesla every day. It's hard to imagine from financial analysis how they'll ever sell enough cars and make enough money to justify the valuation.
David Pearl's reason for coming today was Stephen Stanley. Can you brief Mr. Pearl on the American economy? Is it going to support this multiple expansion?
I think we'll be fine this year. I mean, we're not looking at extraordinary growth, but certainly I think we're looking at decent enough growth. So I think,
And what's your synthesis of that statement? What does that mean for actual rebalancing or reallocating portfolios?
So you want to be in economically sensitive areas that are driven by growth. So consumer spending, you want consumer stocks. And again, we're talking about mid-single-digit growth, not double-digit growth. And then it's the companies that pay you back, pay a dividend, buy back shares with the excess capital.
What's the value of revenue right now? How do you put a multiple on sales? I mean, I think Tom Galvin of DLJ years and years ago as well. What's the price to sales dynamic you see right now?
I think our biggest difference is that when you have a company with no earnings, people seem to put a huge valuation on sales, hoping that somewhere 10 years in the future they're going to make a lot of money. Well, Amazon's been in business 30 years, and large swaths of the business do not make money at Amazon.
Yeah.
Viviana, we're just getting some live pictures of Russia. This is an important conversation. It is Mikhail Mushtin. He is the pick that Vladimir Putin yesterday surprised the markets by trying to make him prime minister. This seems like a done deal, though there are a number, of course, of votes to get through. By speaking to people in the country, he's extremely well respected because he has reformed the tax system, Tom, which was something that, was not easy to do. And what I've heard from people on the ground, again, is that he's considered, a career bureaucrat with not much political desire, but one of the smartest people within the party. So we'll have plenty more on Russia. We're also having a number of headlines from Russian President Vladimir Putin saying that the constitutional changes will boost political parties. This is according to the RAA, which is the national agency of Russia.
A number of stories coming out on this for your briefing this morning in the United States. I'd recommend the New York Times with a great article. And Susan Glasser writes a brilliant essay for Foreign Affairs magazine as well. Right now, back to the market. Stephen Stanley with us with Amherst Pierpont, and David Pearl with us of Epoch Investments. How's business investments, Stephen Stanley? What's the underlying story? Are we going to finally get a lift to help David Pearl?
I think we'll get a little bit this year. As we were talking about before, with the trade deal behind us, there's a little bit more certainty. It's not great, but I think there was probably a lot of activity that was put on the shelf in advance of that, and now with the deal consummated, you'd expect that there would be some revival there in the first half of the year.
Feeds into nominal GDP, which feeds into revenue, which is going to somehow drift to free cash flow. What's the CapEx view you see of all these different companies this year?
Yeah, we agree. CapEx was somewhat contained last year because of the fear, the overhang of a trade war. So things like we heard data centers, believe it or not, were not being upgraded as quickly. Companies were trying to make do. So any discretionary CapEx that you could delay was delayed last year, and we think some of that will come back this year. So we want to own companies that feed into this. Now, the entire semiconductor industry is generally a growth industry, but it's cyclical. It had a trough year last year, and clearly it's coming back. Those stocks have actually been good performers in the last 6 months, but it continues because there really is a lot of growth in data, and companies are now willing to spend where they weren't last year in data centers.
Stephen, are companies reinvesting enough? Or is that the biggest concern out there, that they've been, hoarding cash or giving back to shareholders without putting enough money to work for future growth?
Yeah, I mean, I think we do. The economy needs more business investment, particularly at a time when the labor market is very tight. So this is a time when you would expect businesses to be investing a lot because they're trying to save on labor expense. That was somewhat, I think, interrupted in 2019 because of all the uncertainties around the trade deal and other issues, and so hopefully we'll get back on track this year.
Yeah.
Where do you see that going, David?
Well, we are moving to a more capital-light economy, so it's saying the same thing a different way. We're adding more technology and automation. So, when you get to fast food restaurants, it's going to be more self-service. You don't need as many people there. And labor costs are, in fact, beginning to go up as we're tightening the job market. Structural unemployment is going down. So we're going to see more of this, but it does require investment. So that's the positive here. We will see it.
In the time, David, that I've got left with you, scale is the buzzword. I think it's going to fold right into this year as well. Scale comes to me from a lack of revenue view. Are we going to get enough revenue pop where scale drifts away, the urge to merge drifts away?
It depends on the industry. Some of these industries really do need, the big need to get bigger, Schwab buying TD Ameritrade.
Yeah.
It makes a difference when your pricing is competitive and going down.
Banking, what do you think of the banks? We got Morgan Stanley out today. Who should they merge with? Make some news here.
Yeah, I think those guys are too big to merge. But the mid-tier have been merging or dying. So seriously, in our industry, scale clearly matters in the money management arm, which is really the beautiful part of Morgan Stanley, wealth management. You really do need scale because fees have been going down and economies of scale make it.
Well, let's get into the linen here. Epoch Investment, folks, is legendary for cash flow analysis and what to do down the income statement with the billions and zillions that come in. Give us an active passive update. How do guys like you battle against the passive juggernaut every day?
Yeah, you really just have to stick to your guns. We have a particular philosophy about companies generating cash.
Excuse me, it's a religion.
Yeah, but it's based on actual data. The single best factor that has beat the market over 20 plus years is free cash flow, and then free cash flow yield valuation. So that's what we look for. And there are long periods where that is tough. In the last few years, it's been a growth speculative rally, but when you stick to that and looking different from the market is how you beat the market.
All right, David, what if you can't beat the markets? Or what if there's a significant downturn that makes it very difficult? Do you still catch a falling knife?
Actually, I think active managers will look a lot better in a downturn because of all of the passive. You know, when you're in passive, you have really a one decision trade. You either get in or get out, and you sell everything proportionately, and the good go down as much as the bad, if not more in some cases. So there are real opportunities in a downturn. So again, in Q4 of 18, it was ugly, but active managers in general did better in that environment and even coming out of that environment.